that continuously we are organizing these webinars on every Friday since April 28, 2020. And this journey of sharing knowledge is continuous. And till now, we have completed 169 webinar and today is 170. The purpose of this webinar is to share updated information, new changes, what are the topical interest topic. These are the basic aim, so we can give something to our society from our side. As you are aware, friends, this FEMA regulatory landscape on import and export is a very interesting topic. The FEMA of 1999 is a crucial regulation in India that governs the import and export of goods and service by Indian companies. Established to facilitate external trade and payment and promote the orderly development and maintenance of the foreign exchange market in India. FEMA set forth the procedure, formalities, and documentation required for any Indian companies engaging in international trade. So anybody who is doing trade, export or import, that is, this law is applicable. And you have to follow the principle, procedure, guidelines of this law. This act also outlined the responsibility of exporters and importers and stipulate how foreign exchange is to be handled and impose penalties for violation of its provision. Overall, FEMA plays a vital role in India's economic framework for regulating transactions involving foreign exchange to ensure that they are conducted efficiently legally. As you are aware, friend, that when you do trade in India, you buy, sell, either you are buying or you are selling something, then you are facing so many issues, payment issues, the order issues, the legal issues. Suppose you are supplying something and then this is not up to the mark, so the client is not satisfied and you are facing disputes here. But when it is going across the other jurisdiction of the world, then their law is also applicable, your things are also applicable, and multiple complexities are there. But the most important thing is that all these transactions are happening in foreign currency. So Indian foreign currency law, which is conducted through FEMA, it's coming to the picture because foreign currency is a vital things. Whatever you are sending out or whatever you are receiving, it is not a free flow. You have to follow certain guidelines. Otherwise, there are chances of manipulation. So that's why today this webinar aims to demystify the regulatory framework surrounding foreign exchange management and provide insight into the regulatory provision governing these crucial aspects of international trade. So when you do this trade, you should follow, but simultaneously you have to follow the compliance also. So these compliances you have to follow. There should not be any mistake, any violation, knowingly or unknowingly. That is the main aim for today's webinar. So we want to discuss the key issues, the overview of regulatory ecosystem, what FEMA regulates in import and exports, payment of import invoice and receipt of export proceeds. These are the main things which we want to discuss today. And now, today for this program, we have invited very learned speaker and the person who is from practical field. First, I will welcome Mr. Ashwini Taneja. He is a former member of Income Tax Appellate Tribunal where he delivered more than 2,000 judgments covering wide variety of issues. He is a founder of Prudent Law Chamber and practicing as a lawyer with specialization in PMLA and FEMA law. Some of the landmark cases argued by him on point of law have been widely reported. So today, when you are following FEMA regulation, then there are two types of violations can come. One is the procedural violation. One is the violation which is doing with the bad intention. The money which you are doing transactions, and in the negativity you are involving in money laundering. So that time PMLA law comes into the picture. So, if any violation is there in FEMA, it is very serious in nature. No doubt, if procedural violation is there, you can go for compounding, but sometime procedural violation have some bad intention also. And in that case, it will come under the uh, scheduled offense, which is a part of PMLA, the FEMA violation, and then PMLA authority, PMLA law also applicable. So that is one aspect. So we have requested Ashwini Taneja ji that today we are discussing import and export, but all other things we can do. But what if there is a money laundering aspects? What is the issue if somebody is doing without any intention of money laundering, but he comes under this route? What is the safeguard for him? So I welcome Ashwini Taneja for today's webinar, and we'll definitely benefit by his experience and expertise in PMLA law. Then we have Mr. Kishore Mamidala. He's a assistant general manager of ICICI Bank. He is the subject matter expert of ICICI Bank in the export-import division for more than 9 years in handling product compliance, process, and service aspects of foreign trade business. He has more than 25 years of varied experience encompassing into foreign trade compliances, retail banking, and life insurance industry. So I welcome Kishorji for this program, and he is assistant manager, assistant general manager in ICICI Bank, and day and night he is handling this type of things. So he is the right choice to explain us about the do's and don'ts and what you should follow when you do the foreign trade. And he will give his presentation of practical aspects. So I welcome Kishorji for this program. Then we have Mr. Anupam Gautam, a regional head handling capital account transaction by example, FDI, ODI, ECB, dividend payment, ESOPs, and SNRR with more than 10 years. Having more than 20 years of experience in foreign trade business and compliances, lending business, working capital, LG, VG, buyer credit, retail banking. So Anupam and Mr. Kishore is a right combination to tell us the practical aspects on these issues, which we want to discuss and we want to tell our participants. Then we have next speaker, Mr. Ankit Singhi. He is a head corporate affairs and compliance corporate professional and handling these FEMA business. Then we have Ms. Shweta Agrawal, a senior associate corporate professional and looks after the FEMA related issues. So I welcome Ankit and Shweta for this. They are doing practice in this area. I welcome all. Friends, the program structure is like this. First, Shweta will talk about the regulatory aspects of these two concepts of export and import. What are the do's and what are the don'ts, and what the rules regulation in case of you have done some mistakes, you have done something, and how to rectify this, how to follow this, what compliance they have to do. Then we have after that Kishore Mamidala and Mr. Anupam Gautam. They will tell us the practical aspects, how transaction are proceeds by the bank. Then Mr. Ashwini Taneja will talk about the money laundering aspects, which I just now explained. And then we will have a question answer where Ankit will take lead, and the question answer we will start. Friends, as you are aware that this is the structure of program, and I request all the participants that please come forward, give your queries. We have received few queries, but whatever new queries on the basis of this discussion, or you have your own queries, you please send it to us so we can keep it ready. And the last question answer session, we will devote time to discuss all these issues. So now I just want to make one announcement, because we are continuously organizing webinar. So our next webinar is 171 webinar on buyback strategic decision on 10th May. We are doing this program. So I request to all of you, register as many as people and get the practical tips for this. So over to you, Shweta.
Pawan sir. I want to make one request with
Yeah.
permission of the House.
Yeah.
Actually, this PMLA portion, I have to speak only for 10 minutes. If
Yeah.
you can kindly allow me to give how the PMLA will be linked with it, can be linked with it. I have to attend some urgent call due to some emergency in the hospital. So with my brother. So if you'll allow me, I will cover up this topic and then
Can you do after Sweta, because otherwise people will not feel this. Is it possible?
because Shweta will take around 30-40 minutes.
She will take us.
I have to only speak 10 minutes and it does not matter. Whatever I am going to speak, it does not matter. I'll just give an overview only. How the things can be connected with PML. That is what the public at large in the country wants to know, which I am getting every day, these queries. So it will not have any bearing on whatever technical issues, whichever Shweta and any other dignitary is going to raise.
Actually, but we want that import and export related issues, PMLA, you please confine to that part.
Yes. Only that part. I will speak only 10 minutes.
Okay.
Not that.
Okay.
That is
So
what
now,
Ankit had requested me.
yeah, you can start.
Yes. Thank you. Actually, Ankit requested me to speak for 10 minutes only.
So I'll let me just give a feel. Friends, as you are aware that when you do transaction, you are doing either importing something or you are exporting something. And in both the cases, either money is foreign currency is coming or foreign currency is going out. So in both the cases, you have to follow RBI guidelines, you have to follow FEMA law, you have to follow various things. If there's a procedural violation, there's a compounding process. But sometime you are doing some violation which underlying principle is not the procedural, but you have some bad intention, and the intention is that you want to do money laundering. Like, for example, you are over invoicing, you are under invoicing, you are getting money and then parking money in the other country by under the guise of export, and then import you are doing some undervalue and high value, whatever suits you, you are doing. These are not allowed. These are not the procedural violation. This is not a compoundable also. These are the penalty and this is the criminal things. So this is a laundering thing. So PMLA comes into picture. So I'll request Ashwini Taneja sir to tell us that in what types of cases in export and import this PMLA comes into picture.
Thank you, Pawanji. In fact, this is what it's such a hot topic that everybody in the country, almost whosoever is having any dealing with imports or exports or any international transaction or in any manner connected with this department, they are raising these queries. It's because of two reasons. First reason is that the task of enforcement of FEMA, for which we have gathered here today, and the task of enforcement of PMLA, that is Anti-Money Laundering Law, Prevention of Money Laundering Act. Both have been given to single agency, whom we know as Directorate of Enforcement. And that is a cause of concern, that is a cause of confusion, and rightly so, because it is also seen when people get summons and notices from this department, they get confused that it is whether under FEMA or it is because of under PMLA. And I mean, unfortunately, in some cases, the agency is also not willing to clarify it, because the effect under PMLA is quite different from effect under FEMA. So for that reason also, the agencies are not able to, they are not willing to at all clarify that whether this has been issued under PMLA or has been issued under FEMA. I will give a brief background for 2-3 things. Firstly, I have been asked to clarify what kind of transactions can be roped in under money laundering, A, and B, how to make a distinction that it is under FEMA or it is under PMLA if the notice is received, and how to attend to some these kind of summons or notices, meaning thereby how to, I mean, comply with the investigation procedure of the department initiated by this department. So firstly, before I say that what kind of transactions can be roped in, I will give a very brief background in 2-3 minutes about what exactly the money laundering is. In fact, if you closely watch, you will see that money laundering is loosely, this term is used loosely at many places. But whether all those transactions will fall under money laundering? No, it is not like that. Because money laundering is something where the technically speaking, the offense of money laundering has happened. Somebody was saying, sir, conversion of black into white is also money laundering. No, conversion of black into white is only tax evasion. So what is money laundering then? Three conditions are required to happen money laundering. First of all, the commission of scheduled offense. Scheduled offense has happened. Happening of scheduled offense is necessary part, mandatory part, which has been confirmed by Supreme Court also in Vijay Badan Lal and Pawan Dibbar and few other judgments which have just come. Second, there should be generation of proceeds of crime with the happening of scheduled offense. Third, from the proceeds of crime so generated, the person accused of the offense of scheduled offense and offense of money laundering should project the proceeds so generated as good money. Meaning that the three stages should happen simultaneously. I will repeat again, scheduled offense has happened. Scheduled offense means an offense which is mentioned in the schedule appended with PMLA. That has happened. Some proceeds have generated therefrom. And thirdly, those proceeds have been shown as good money. Tainted money has been shown as untainted money by the concerned person. That is broadly the concept of money laundering, legally speaking, conceptually speaking, practically speaking. These three ingredients are necessary. Now, coming back to this topic of import and export. So, normally, if any violation is done with regard to inflow or outflow of foreign exchange, the law which will be violated will be FEMA in for all practical purposes. But if something else has also happened in addition to that, then offense of money laundering can also said to have taken place. For example, if somebody is making fake imports, meaning thereby import of goods or import of services, meaning thereby, just to give an example, somebody is importing software, but actually no software is imported, only bill is raised, import bill is received, payment is made. Somebody is inflating the price of the imports. Somebody is taking the money out on some other pretext, for example, transport bill, shipping bill, or in the name of any other service or import of goods, which is bogus in fact, or overpriced. Vice versa, somebody is exporting. Export is of the goods which have actually not been exported. Say goods X has been exported as per bill, but actually export or has happened of Y. In imports, suppose the purpose was to somehow deliver the money outside. Instead of hawala, it is going through banking channels. So here, how PMLA can be also connected will be where the money is generated from commission of some offense. Suppose some illegal money has been generated here. If you can recapitulate in newspapers, there was news about lot of actions happening on Chinese companies, fintech companies, on the ground, on the pretext that there are violations under FEMA, but there are allegations under PMLA also, because the allegation is that whatever earning has been done here, that has been done after commission of some offenses. So if some offense has also been committed, and there is a long list of offenses, say offense under IPC, offense under many laws which have been mentioned there, environmental laws have been mentioned there, custom violation has been mentioned there, Black Money Act has been mentioned there. So many laws have been mentioned there. So if a violation takes place of any law and proceeds are generated therefrom, then PMLA will also get attracted. So there could be examples and examples. Royalty payment is funds are being remitted out of the country in the name of royalty. That is also one of the allegations against these Chinese companies, that in the name of royalty, they are making excessive payment. The transaction is not at arm's length. Transaction is dubious. Transaction is make-believe. So these kinds of things can also be dragged into the provisions of PMLA. Wherever the money is generated from commission of an offense, and the money is being sent out also under the pretext of imports or being received under the pretext of exports. Suppose illegal money earned outside, it is to be received in India, and the illegal money is received by way of bogus exports, then it will be connected straight away with PMLA. PMLA also has far-reaching implications under cross-border transactions also. Any property taken outside India can also be attached under Section 5 of PMLA. Section 21U, which defines pursuits of crime, specifically says if money is held or if the pursuits of crime are held or taken outside India, then property held in India of the equivalent value can also be attached. And with the help of LR, letter rotatory, the properties located outside India can also be attached. So that is a brief about how PMLA can be invoked under import and export related matters, or wherever actually FEMA was to be invoked, but PMLA is also been invoked. Now coming back to the main thing which Ankit was requesting me, ki, sir, when people get notice, a lot of shivering happens. Shivering happens for two reasons. First, notice is sometimes making a mention under section 37 clearly, but under sometimes notice is issued under section 50, whereas no money laundering has been done by the person, international transactions has been done, but it should be ideally a FEMA notice, and sometimes no sections are mentioned. So first of all, how to make a distinction ostensibly that notice is under FEMA or under PMLA? If you carefully notice, if on the notice, if you observe, numbers are always mentioned, reference numbers. In the reference number, if it is under FEMA, it will start with the code letter T. All FEMA notices are issued under letter beginning with T, T for Tata. PMLA notice mentions about some ECIR. Even if it is HIU, STF matter, they will definitely mention about some kind of ECIR. Then it will be, some hint will be given that this is FEMA matter. This is a PMLA matter. Otherwise, if T is reference, it is beginning with T and no ECR number is mentioned, then it is simply a FEMA notice. That is number one. Number two, how to handle it? What is the difference between PMLA and FEMA? Friends, there is a lot of difference, and we must bring in our mind. Whenever FEMA notice is sent by the agency, they will never spell out that this is for FEMA only, because the powers and the implications under PMLA and FEMA are different. The major difference, first of all, is that under PMLA, the enforcement director has power to arrest the accused under section 19 of PMLA. Under FEMA, neither there is any power of arrest, nor there is any power of prosecution. Under FEMA, implication is only monetary levy of penalty. That's it, nothing more. So please be clear about it. It will reduce half of your pain whenever any notice is received. Because somebody was telling me a few days back, he had to attend an investigation with the enforcement directorate, that his interrogation was happening at a floor where lockup rooms were also there. And just outside the lockup room, his interrogation was happening, as if the impression was being given that as if he can be put inside in case the department is not satisfied with his reply. But friends, under FEMA, there is no power of arrest, only there is no power of prosecution. So since there is no power of prosecution, there will not be any power of arrest also. Under PMLA, their implications are attachment of property, arrest, prosecution, fine, etc. Here only fine is there, nothing else. So therefore, under FEMA, if the notice is received, we have to bring out the factual details. Suppose it is with regard to import, we have to prove the things, the factual details to the hilt with regard to the imports, that actually the import has happened. We will end up submitting details with regard to bill of lading, our bank statements, other bills, shipping bills, etc. No, please also show your stock register. Also show that where the material has been consumed, so that you can show that actually the import has happened. Similarly, with regard to export, also similar documents are required. So under FEMA, what we have to give is the factual details to complete the process, so that the genuineness of the transactions can be. If the things are being dragged under PMLA because scheduled offense has happened, then friends, then the notice will be issued under section 50 of PMLA, and then that will be a different ball game. As Pawan sir has requested that today we have to confine under FEMA only, I will not be taking you into the deep valley of the discussion under PMLA, because that requires an independent discussion in itself. That if the charge is under offense of money laundering, what are the precautions? What exactly is money laundering? What is the definition of pursuits of crime? What is the powers under attachment under section 5? What are the rights and responsibility of the accused under PMLA? What are the implications, etc.? So, I mean, this is a topic which requires a deliberate discussion. But with regard to FEMA only, I will say only one thing, that provisions of PMLA will be invoked only when there is a scheduled offense. Otherwise, provisions of PMLA will not be invoked. I think that is what I have been asked to do as far as today's deliberations is concerned. And I'm sorry, Shweta, I have taken your turn, and I'm really, really grateful to you for giving me this chance.
No issues, sir. No issues.
Thank you, Pawan sir.
Okay.
Everybody,
Okay.
thank you, all the respected dignitaries.
Thank you very much, Shweta. Now, give your presentation and tell us about this.
Thank you.
Good evening, everyone. So, our today's topic, as already stated by Pawan sir and Ashwin sir also, we are going to speak about FEMA regulatory landscape on import and export of goods and services. So, before delving into the regulatory framework governing the import and export of goods and services, it is important that we understand the regulatory ecosystem designed by the Indian authorities and the framework issued thereon. The very first, the Reserve Bank of India, RBI, has issued the Foreign Exchange Management Act in order to oversee transactions with the help of the AD Bank, which act as their authorized representative under FEMA. So under FEMA, RBI has designed regulatory framework, rules and regulations, and the master directions through which it looks after the import and export transactions undertaken by the Indian parties. Directorate General of Foreign Trade that has formulated the foreign trade policy in order to regulate the foreign trade activities. Then the custom authorities, these authorities administer customs provisions in accordance with the Custom Act. Next, under FEMA, as I've stated, RBI has formulated rules and regulations. So for import of goods and services, Foreign Exchange Management, Current Account Transaction Rules 2000, and the Master Directions on Import of Goods and Services lays down the provisions with respect to import of goods and services. Then for export, similarly, export of goods and services regulations are there, and the master direction on export of goods and services are provided. So in today's webinar, we will talk about what FEMA regulates, and it is very important to understand the objective of FEMA, that why it is regulating. So section 5 and 7 of FEMA lays down the provisions with respect to import and export of goods and services with an objective to regulate the inflow and outflow of foreign exchange. It facilitates external trade and develop and maintain the foreign exchange markets in India. What FEMA regulates, the purpose is to the overall purpose of FEMA in the foreign exchange transactions is the regulatory framework revolves around the receipt of export proceeds and payment of import invoices. So before going to the provisions, let's first understand the key terms. Import means bringing any goods and services into India from foreign jurisdiction to of the another country into the territory of India. The next term, what is export? Export means taking or sending goods out of India to a place outside India by land, by sea, air, or consignment, or by way of sale, lease, hire, purchase, or under any other arrangement by whatever name called. Further, in the case of software, also includes transmission through any electronic media. The next term is service. What is service? Service means any description, any service of any description which is made available to the potential users and include the provision of facilities in connection with banking, financing, insurance, medical assistance, legal assistance, chit fund, real estate, transport, processing, supply of electrical or any other energy, boarding or lodging or both, entertainment, amusement, or the purview of news or other information, but it does not include the rendering of any service free of charge or under any contract of personal service. Software means any computer programs, database, drawing, design, audio-visual signals, any information by whatever name called, in or any medium other than in or any physical medium. The next term is what is foreign exchange? Foreign exchange means the foreign currencies and includes deposit, credits, and balance payables in any foreign currency. Drafts, traveler's check, letter of credit, or bill of exchange expressed or drawn in Indian currency but payable in any foreign currency. Drafts, traveler checks are also included in the terms of the foreign exchange. The next term is deferred payment arrangement. So basically, deferred payment arrangement is an agreement between a lender and a borrower where the buyer proposes to pay against the invoices at a later date. Now, we will talk about the import of goods and services and how FEMA regulates the payment of import invoices. So whenever an Indian party import any goods and services in India, they have to comply with the time limit for the settlement of import payments. So in case of normal imports, settlement of invoices shall be completed within 6 months from the date of shipment. Therein, the importer shall clear the payments of invoices within the 6 months from the date of their shipments. And in cases of books, there is no time limit with respect to the remittances. However, the Indian importers are required to comply with the payment of interest. Further, the Indian importers shall make sure that whatever payment they are making, that shall be equivalent to the amount of invoices. There shall not be any difference between the payment made and the actual amount of invoice, which has been raised by the foreign supplier. Now, there are cases where the Indian importers are unable to make the payments within the specified time limit of 6 months. So what they can do? In those cases, they can go to their AD bank to seek the extension of time limit. So AD banks are permitted to grant extension of time for the settlement of import dues subject to compliance with the provision of the payment interest. How much extension can the AD bank give? AD banks are permitted by the RBI to extend the time limit for the payment up to 6 months at a particular time upon submission of an application by the Indian importers. And this time limit can be extended up to 3 years maximum by the AD bank. What are the reasons through which Indian importer can go to the AD bank and get the extension? So the reason for extensions can be that there is any dispute between the Indian importer and the foreign supplier on the basis of the quantity of the goods supplied or the quality of the goods supplied. Second can be the non-fulfillment of any terms of contract. Third, it can be the financial difficulties faced by the Indian importer. And the last can be the suit filed by the importer against the foreign seller. So considering these reasons, an Indian importer can go to an AD bank, to the concerned AD bank, in order to get an extension to make the payment to the foreign supplier. While giving the extension of time limit, AD bank must ensure that the invoices over which the Indian importer has came to get an extension shall not be under any type of an investigation by the ED or CBI or any other agencies. Further, in cases where the extension is going beyond the period of 1 year, it shall make sure that the dues outstanding shall not exceed $1 million or 10% of the average import remittances in past 2 financial year, whichever is lower. So the AD bank is under the obligation in order to make sure that both of these conditions are in compliance, and post that compliance only they are eligible to give the extension. So let's understand with a case study that how the extension procedure works. The fact of the case is there is a company ABC Limited which is specializing in the manufacturing of electronic products, has been importing electronic components and instruments from a US-based company named PQR LLC. Over the years, ABC Limited has accumulated outstanding invoices for these imports, totaling $1 million from the financial year 2011 to 2018. However, due to the financial constraint, this particular Indian company was unable to settle these invoices. As of the fiscal year 23-24, ABC Limited has successfully recovered from its previous losses and now possesses adequate financial resources to address its outstanding liabilities, including the $1 million owed to PQR LLC. Now the question is whether the AD bank can give the extension covering the non-payment due to the financial crunch without getting any RBI approval under the automatic route. So as we see that the import invoices are pending from the financial year 2011 to 2018, the company ABC Limited in 23-24 financial year willing to pay the pending invoices. So the time period of 3 years has been lapsed. So as per the provision, AD banks are required to go to the RBI in order to obtain the approval before making the payment on behalf of the Indian importer. However, in one of the cases, we have seen that considering the financial crunch, and if the Indian importer have complied with the extension provisions and had intimated the concerned AD bank with respect to its financial crunches, AD bank itself is allowed to go ahead with the payments without obtaining RBI approval. So in case-to-case basis, the AD bank has been empowered from the RBI that they can go ahead with respect to the payments without obtaining any RBI approval. So the case study 2, it covers the another aspect of the approval for the outstanding invoices. So there an Indian company, PQR Limited, which is engaged into the manufacturing of home appliances, which imports raw material and spare parts for the said appliances. During the financial year 2013 and 14 to 16-17, the company imported the raw material from a China-based company. However, due to quality issues, the payment for these imports remained outstanding. Post several correspondences and the technical evaluation, the foreign supplier resolved the quality issues in the financial year 2020 and 23. The company has approached the AD bank to clear the outstanding invoices and has been advised by the AD bank to approach RBI to get the prior approval, as the payment had been delayed for more than 3 years. So now the question is whether the Indian company is eligible to go to the RBI giving all the details of the outstanding invoices collectively, or it shall apply in a staggered manner. So here we have seen that AD Bank and the RBI permits the Indian company to give all the details with respect to the outstanding invoices. However, Indian companies shall present a staggered manner of payments, a schedule of payment with respect to the invoices considering the financial year wise, and then they shall make the payment. So accordingly, the payment, RBI will not allow the Indian company to clear all the outstanding invoices for multiple financial year in one go. It will allow it on the financial year basis or some other basis. Accordingly, Indian company shall apply for the clearance of invoices in this staggered schedule. Now coming to that, whether an Indian importer who is importing any goods from the foreign supplier is eligible to give advance remittances, that is the advance payment to the foreign supplier. So the regulatory framework of import of goods and services permit Indian importers to make payment up to $2 lakh as an advance payment to the foreign supplier without any kind of intimation, approval, or additional submission of documents. However, in case the amount exceeds $2 lakh, then the Indian importer shall obtain an unconditional irrevocable standby LOC, letter of credit from the foreign supplier, or it shall obtain a guarantee from the international bank situated outside India, or a guarantee from an AD bank in India with the counter guarantee of an international bank outside India. So the Indian importers are obligated to obtain any of the document in case they are making the payment as an advance payment exceeding the amount of $2 lakh. Further, the AD banks has been empowered by the RBI that if they are satisfied with the track record and of the Indian importer and the importer's transaction is the bona fide transaction, then for an amount of up to $5 million, AD bank can allow advance payment without obtaining any type of document, that is the letter of credit or the guarantee. And for the PSUs, that is the public sector undertakings, RBI has stated the limit of $1 lakh that in case they are willing to make the payment as an advance payment for this particular amount, then they have to obtain a guarantee from the foreign bank. And it shall also, and if in case they are unable to obtain such guarantee from a foreign bank, then that particular PSU shall obtain a waiver from the bank guarantee from the Ministry of Finance. That is, the PSU has to do either of the thing. Either they have to get a guarantee from a foreign bank, or they have to get a waiver from the Ministry of Finance in order to obtain the bank guarantees and make the advance payment for an amount exceeding 1 lakh USD. Whether the advance remittances are permitted in case of import of services as well. So yes, the amount of USD 5 lakh has been made under the automatic route. That is, no intimation, no approval, no further documentation is required. Indian importers are permitted to make advance payment up to this particular amount. For an amount exceeding 5 lakh USD, Indian importer is required to obtain a guarantee and submit the same to the concerned AD bank. And the guarantee can be from the international bank situated outside India, or a guarantee from an AD bank in India with a counter guarantee of an international bank outside India. In case the PSU are making the payment as an advance payment for import of services for an amount exceeding USD 1 lakh, then they have to obtain the bank guarantee, that is a guarantee from a foreign bank. And in case they are unable to obtain such guarantee, then they have to go to the Ministry of Finance to obtain a waiver from the bank guarantee before making any kind of advance payment. Further, RBI has issued specific provisions regarding the import of rough diamonds, aircrafts, helicopters, and other aviation purchases. And the Indian importers who are dealing in any of these products, they have to comply with those specific provisions. Now, let's go ahead with a case study. And the case study is all about the technical and strategic services imported by PQR Limited, an Indian company, and these services are taken by this Indian company from its holding company PQE LLC, which is based in USA. And in order to get these technical and strategic services, PQR Limited has entered into a strategic service agreement with PQ LLC. As per this agreement, PQR Limited is required to pay the upfront fees to its holding company, that is the supplier of service, upon the demand. And on several instances, the company has made advance remittances for the import of strategic service. So now the question is that whether PQR Limited, the Indian company, is required to obtain guarantee from the overseas beneficiary. So yes, the company is required to obtain the guarantee if it is exceeding the amount of USD 5 lakh, that is the permitted amount in case of the import of services. In case the advance payments are below to this particular amount, then there is no requirement to obtain any guarantee from the overseas beneficiary. So in a gist, if the company is breaching the permitted limit, then the guarantee is required. And if it is not breaching the permitted limit, then no guarantee is required. Now coming to the deferred payment arrangement. Let's first go ahead with the concept of deferred payment arrangement. This arrangement is an agreement between the lender and a borrower where the buyer proposes to pay against the invoices at a later date. And RBI has permitted the Indian importers to enter into such kind of deferred payment arrangements with the foreign suppliers. In order to import the capital goods on the deferred payment arrangement basis, Indian importers are permitted to enter into an agreement to defer the payment, that is to delay the payment for a period of maximum 3 years. And in case of non-capital goods, the importers can defer the payment for a period of 1 year or for the operating cycle, whichever is less. So how next concept is remittances against replacement imports. So why an Indian importer will be required to replace the goods which has been imported? So there can be instances where their goods imported are short supplied goods, they are the damaged goods, they are short landed goods, or the goods got lost into the transit. Then what the Indian importer can do? So the very first thing, the AD banks are required, Indian importer is required to first inform the AD bank with respect to any of the short supplied good, damaged good, short landed good, or lost in transit. Accordingly, the original endorsement to the extent of value of goods lost shall be cancelled by the AD bank post receiving the information from the importer and the customs department. Then the fresh remittance for replacement imports may be permitted by the AD bank itself, provided the insurance claim relating to the lost goods has been settled in favor of the importer. Then the re-import of replaced goods shall be done within the validity period of license. Proper remarks and indicator must be entered by the AD bank for generating outward remittance message, that is the ORM, mark of closure of bills in the IDPMS. So IDPMS is basically a software which records all the data with respect to import of goods and services, and we will be discussing about IDPMS into the slides upcoming. Now, whether the third-party payments are permitted for the Indian importers. What is third-party payment? Let's understand that first. Third-party payment is a business deal that involves a person or the entity as the payer of invoices. The regulatory framework of import permits Indian importers to make third payment to the third party who is not the seller. That is, there are three parties in total into the agreement. First is the Indian importer who is importing goods from a foreign supplier, and Indian importer has been instructed by the foreign supplier that it is not required to make the payment to the foreign supplier directly against the invoices raised by it. The payment are required to be made by some other party. Let's understand with this with an example that ABC Limited is an Indian importer which has imported goods from the PQR LLC, that is the foreign supplier, and foreign supplier has instructed the ABC Limited that it is required to make the payment directly to RST-PTE, which is the payment receiver. So this overall arrangement is known as the third-party payment arrangements. RBI permit this type of arrangements for the Indian importers. And what are the conditions? The third-party payment fact shall be mentioned into the irrevocable purchase order, tri-party agreement, or the invoice, which states that this third-party arrangement shall be a pre-arrangement, and the information with respect to this arrangement shall be mentioned on the invoices, or a tri-party agreement shall be entered. Then the AD bank should be satisfied with the bona fide of transactions and should consider FATF statement before handling the transactions. Third, the invoice and bill of entry shall mention the narration related to the third-party payments. So all these three conditions are required to be met by the Indian importer before making any import on third-party arrangement basis. Now coming to the IDPMS, that is Import Data Processing and Monitoring System, and why this system has been established. So the basic purpose of the system is to enable the AD bank to track the payments. With the purpose of tracking the import transaction through the banking system, RBI introduced the concept of IDPMS in the year 2016. The system has been developed in consideration with the Customs Department, AD Bank, and the other stakeholders. This particular portal helps to track and effectively monitor all the regulatory reporting along with the status of payments. The data in IDPMS is inserted by the AD Bank, by the Customs Department, and the importer on the real-time basis. With the help of this software, the data of remittance and bill of entry is mapped to know the status of import transaction. That whether the import transaction which has been closed or not, whether the import has been made and the payment has been made to the foreign supplier, this overall process of import of goods and services is recorded into this IDPMS software. Upon closure of a transaction, the AD banks are required to issue outward remittance message to the importers. Now, how this particular software operates and what are the obligation of the AD bank. So the very first obligation of the AD bank is to ensure generation of outward remittance message upon the payment of the imported goods. Further, they also have to ensure settlement of bill of entries and the ORMs. So they have to make sure that the concerned bill of entry shall be settled with the concerned ORM itself. In cases of advance payments, the AD banks are also obligated to enter the details of the bill of entry, that is the bill of entry number, port code, and the date of entry for the outward remittance associated. The outward remittance which has already been made by the Indian importer on advance basis. Then the AD bank are also required to ensure document submission, outward remittance data, they have to match the outward remittance message. They have to close the transactions as per the IDPMS guidelines. Upon closure or settlement of the outward remittance message, the Indian AD banks are also obligated to issue an acknowledgement slip to the importers, and that particular slip shall include the following details, that is importer's full name and address with the code number. Second, number and date of bill of entry and amount of import. And in the last, it shall also include the recap advice of the number and the amount of bill of entry and outward remittance not settled by the importer. Now coming to the obligations under the IDPMS software for the Indian importers. So Indian importers are obligated to ensure that the data with respect to bill of entry has been inserted into the IDPMS in order to evidence the import. Then they shall also preserve the printed importer copy of bill of entry as an evidentiary proof for the import and acknowledgement slip for the future use. So these slips and the importer's copy of bill of entry, they have to make sure that they have it into their records. Now, how the ORM and bill of entries are settled? Can the outward remittance message, single outward remittance message can be settled for multiple BOEs or the vice versa? So yes, the IDPMS permits the Indian importers and the AD banks to settle one receipt of payment, and they are permitted to settle one single import against the number of payment in the cases where the Indian importer make the payment into the tranches, and where the Indian importers also have made a single payment against multiple imports, that is against multiple bill of entry. So practically these kind of arrangements has been executed, and the IDPMS also permits the AD bank and the importers to execute the same and put the particular data in the IDPMS with respect to multiple payments against one import or multiple imports against one payment. Now, how the imports can be evidenced. So what are the documents which are required to be submitted with the AD bank? So in case of physical import, Indian importer is required to submit the bill of entry. And in case of non-physical import, they are required to submit a certificate from a CA certifying the receipt of services. What are non-physical import? These can be the softwares, the designs, the drawings received through the email and the fax. So they are required to get a certificate from a CA evidencing that they have received these softwares or drawings or designs over the email or the fax. So now coming to the another concept, that is receipt of documents by the importer directly from the overseas supplier. So as per the RBI provision, import bills and documents shall be received from the banker of the overseas supplier directly by the AD bank of the importer in India. And in cases where the documents are not received by the AD bank, no remittance shall be made to the overseas supplier. So RBI does not permit the remittances through the AD bank in case the AD bank is not in receipt of the documents from the overseas supplier banker. However, in certain cases, RBI has permitted exemption over this obligation, and the cases can be that the value of import bill does not exceed USD 3 lakh. Import bills received by an Indian wholly owned subsidiary of a foreign company from their principals. And the last is import bill received by the status holder exporters, 100% export-oriented units in SEZ, public sector undertakings, and the limited companies. Limited company means the public limited companies and all type of other limited companies. So in these particular cases, the Indian importer can receive documents directly from the overseas banker, and the AD bank is not under the obligation to receive directly from the banker of the supplier. Now, till here, we have talked about the payment schedule and the provision with respect to the payments in case of import of goods and services. Now, the FEMA regulatory framework also lays down the provisions with respect to export of goods and services, and how the exporters, Indian exporters who are exporting goods or services to any foreign party, and how they have to receive the export proceeds from such foreign parties. So the very first provision talks about the time limit within which the Indian exporters shall ensure that they have received the payments from the foreign clients. So in general, exporters are permitted to complete their payment within 9 months from the date of their export. And in case of export to the warehouses, that is where the Indian exporters export goods to their own warehouse into the foreign jurisdiction. In those particular cases, RBI has given them a leverage to realize the payment within 15 months from the date of shipment. The Indian exporters are also obligated to ensure that whatever amount they have received as an amount export proceed, that shall be equivalent to the amount of invoice raised by them. Now, whether in case what an exporter can do in case they are not able to fetch the payment from the foreign clients. So they are permitted to get an extension from their AD bank, and AD banks are also empowered by the RBI to permit and grant extension time for a period of 6 months at a time, subject to the conditions below. First, that the Indian exporter is unable to realize the payment for reasons beyond his control. And second, the declaration to the AD bank by the exporter has been submitted, which states that the proceeds will be realized during the extended period. So in this particular case, the exporters are permitted to go and submit an application to its concerned AD bank in order to get an extension of time to receive the payment. If an exporter does this particular task, they are in compliance with the provisions of the FEMA regulations. And in case an Indian importer does not go and submit an application to the AD bank to seek the extension, then in those cases, they are triggering to the contravention with the provisions. So Indian exporters, and also in case of imported goods, Indian importers are mandated and obligated to comply with this particular requirement of law. Now, when the AD banks are ensuring and when they are granting the extension, they are required to ensure that the exporter who has approached to them, he is not under any investigation from the ED or the CBI or any other agency. And in cases where the extension which they are granting that extends the period of 1 year, they have to make sure that the overall dues outstanding does not exceed $1 million or 10% of the average export realization in past 3 financial year, whichever is higher. So AD Bank has been obligated by the RBI to comply with these 2 provisions and the conditions while granting the extension. Now, how the Indian exporters receive payment? What are the mode through which they can receive the payment from their foreign clients? So the Indian exporters are permitted to receive the payment through the AD bank, that is through the banking channel. Secondly, even the exporters, when they are visiting to their foreign jurisdiction, they can receive the payment from the foreign clients, and the payment shall be received into their Nostro account. First, what is Nostro account? Let's understand that first. Nostro account refers to an account that a bank of a country holds into foreign currency in a bank of another country. So if an Indian exporter holds a Nostro account into a foreign jurisdiction, they can receive the payment into that particular account from their foreign client. Second, they can receive the payment into the credit card, or there can be a debit to the credit card of the importer subject to the reimbursement by the foreign entity. And third, online payment gateway service providers can also be used in order to receive the value of the export, subject to that the value of invoice does not exceed $10,000. Now, whether the Indian exporters are permitted to receive the advance payments in case of export, which they will be doing in future time. Yes, RBI has permitted Indian exporters to receive the payment in advance from their foreign clients, subject to compliance with certain conditions. The very first is the exporter shall ensure that shipment of goods within 1 year from the date of receipt of payment shall be made. That is, the Indian exporter shall export the goods to the foreign clients within a period of 1 year from the date of receipt of payment. And they can do it with or without interest. Secondly, in case of inability to make this shipment, then the Indian importers are required to refund the advance payment received from the foreign client, and In case they are unable to make that refund within the permitted period of 1 year, then they have to go to the RBI to obtain their prior approval. That is, post completion of 1 year from the date of receipt of payment, if the Indian exporters are unable to make the export, then they have to approach RBI first to get their prior approval before making any type of refund to the foreign clients. Lastly, for the long-term contracts, advance payments may be received from maximum tenure of 10 years, subject to compliance with the conditions specified therein. So there can be the contracts, and the industry does enter into long-term contracts in which the goods are supposed to be exported post 1 year, and that tenure is required to manufacture and set those products and the goods. Then the Indian exporters are even permitted to get advance payments with a maximum tenure of 10 years. Now, the third-party payments. That there are cases when the Indian exporter, which has exported goods to the foreign client, receive payment from some other party, not directly from the foreign client. So whether these type of arrangements are permitted, yes, these type of arrangements are permitted under the regulatory framework, subject to compliance with certain conditions. And the Indian exporter can receive the payment from some other party. So the very first condition in order to enter into a third-party payment, that this particular disclosure, the disclosure of this agreement shall be given into the irrevocable purchase order, tri-party agreement, or the invoice. So these details shall be provided to the AD Bank, to the Custom Department in any of these documents. Secondly, the AD Bank shall be satisfied with the bona fide of the transactions and the export documents submitted by the exporter, and the payment shall be routed through the bank only, that is the concerned AD Bank. Next, export declaration form, the form EDF shall also mention the narration related to the third-party payments. Thirdly, lastly, the realization of export proceeds is the responsibility of the exporter, and the declaration upon receipt of payment shall be submitted. It means that the exporter itself is responsible to make the realization to receive the export proceeds, and post receiving the export proceed, they shall submit a declaration with respect to the same to the AD Bank. Now, what if the exporter is unable to realize the export proceeds post making all the possible efforts, and they are unable to receive the payments from the foreign clients? So whether RBI permits the write-off of the invoices raised by the Indian importers on the basis of the genuine reasons, then yes, RBI does permit under the regulatory framework and allows Indian exporters to write off the amounts, that is the payment which they are supposed to receive from the foreign client. However, RBI has given the limit, and it has to be complied by all the exporters. So the very first thing, that non-status holder exporters are permitted to self-write off the total export proceeds, to self-write off the export invoices up to the limit of 5% of the total export proceeds realized during the period of a calendar year. And in case of the status holder exporters, RBI permit self-write-off of export invoices up to 10% of total export proceeds realized during the preceding calendar year. And in case they want to exceed the limit, then they have to write off through the AD Bank. Now coming to the another concept which addresses both the import of goods and services regulation and the export of goods and services. So here we are going to talk about the set of export payments which are required to be received and the import payments which are required to be made. So there are possibility that an Indian company is doing both import of goods and services and export of goods and services simultaneously. So whether they are permitted to set off their export receivables against the import payables. So the answer is yes. RBI permits export receivables against import payables with the same overseas party. That is, the set off of invoices of goods can be done with the invoices of receivables of goods. That is, the Indian importer who is importing goods from one overseas party can set off the payments with the export receivables against that good from the same particular overseas party. In cases where the set off of goods and services are required, that is not permitted by the RBI. So set off of invoices of goods with the services cannot be done. Second part is export receivables against import payables within the group companies. Is it permitted? Yes, it can be permitted that the group companies can set off their export receivables against their import payables through an in-house agreement or outsourced centralized settlement agreement. Post entering into any of the agreement, they can set off their export receivables and import payables. Let's understand this provision with the help of a case study. So ABC Limited, which is an Indian apparel company, exports its goods to the European market. Further, it has also entered into an agreement with Miss Lisa, which is an international designer, in order to get her services. Miss Lisa is based in the UK and designs the apparels on behalf of ABC Limited. Additionally, ABC Limited also export apparels to Miss Lisa for sale at her boutique. So basically here, the ABC Limited is exporting goods, that is the apparels, to Miss Lisa. Simultaneously, it is getting a service from Miss Lisa with respect to the designing services. So currently, ABC Limited has export receivables aggregating to USD 10 crores, which includes the amount of USD 50 lakhs, which is outstanding to be received from Miss Lisa. And it also have the outstanding payables to Miss Lisa up to amount USD 40 lakh towards her designing services. So here the ABC Limited wants to understand that whether it is permitted to offset the receivables against the payables to Miss Lisa. So the very first condition that the overseas party shall be the same party is complied here. However, RBI does not permit offset of receivables of goods to the offset of payables of services. So here in this case, ABC Limited cannot offset its receivable against the payables to Miss Lisa. Now, let's understand the reporting required to be made by the Indian exporters to its AD bank. So in case of export of goods, Indian exporters are required to submit export declaration form, and in case of export of softwares, they are required to submit the form Softex to their AD bank, giving the details with respect to exports made by them. So what are the evidentiary documents in case of exports? So the evidence which are required to be submitted to the AD bank in case of physical export is the export declaration form, and the other document is the shipping bill. Now coming to the export data processing and monitoring system, known as EDPMS, as we have spoken about the software IDPMS into the import of goods and services section. The similar software has been designed by the bank, by the RBI, in order to track the export transactions, and the software is known as EDPMS. This particular software has been designed with a purpose to track export transaction through the banking system, and it was introduced in the year 2014. This system has been developed in consideration with the Customs Department, AD Bank, and the stakeholders involved. Now, the portal helps to track and effectively monitor all the regulatory reporting along with the status of payments. This particular software inserts the data on the real-time basis and help the stakeholders to collate the information with respect to the remittances made and the bill of entry, and it maps both these details to know the status of an export transaction, that is whether the export has been made by the Indian exporter against a payment which it has received in advance, or whether the Indian exporter have received the payment with respect to an export already made by it. A report is also generated under this EDPMS system, which is known as Export Outstanding Statement, and it compiles all the details with respect to the outstanding dues, and this particular report is generated by the AD Bank on half-yearly basis. So what are the obligations under the EDPMS? for the AD bank that what they have to do. So the issuance of electronic bank realization certificate is required to be done by the AD bank, and it shall update the data with respect to all inward remittances, that is the export proceeds in EDPMS, to ensure consistency of data and the consistency of data inserted in the EDPMS and the EBRC. Secondly, export bills registers shall be maintained by the AD bank in physical or in e-form aligned with the EDPMS. The bill number should be given to all type of export transactions on a financial year basis, that is April to March, and the said details shall be reported in EDPMS. Now, in cases of write-off of export bills within the limits permitted by the RBI, the AD bank shall also report this particular fact, that is the write-off of any export bills, into the EDPMS. Now, let's understand that how important these entries of EDPMS and IDPMS, whether the Indian company is required to track the closure of transaction into these systems, either if they are making import, then IDPMS, and if they are making export, then EDPMS. So here in case, ABC Limited is an Indian company which is manufacturer of automobile part. In order to facilitate its business operation, the company engages into the import of raw materials and also exports the finished goods into the global market. Then the Indian company has diligently settled all the receipts and payments related to its export and import of goods transactions respectively. And with respect to the third-party payments and the return of invoices, they have complied with all the stated provisions. However, post submission of all the documents with the AD bank, there are certain transactions which remained open into the EDPMS software and the IDPMS platform. Here it is important to understand first thing that the Indian entity ABC Limited has done all the compliances on its part. It has settled all the receipts, it has settled all the payment. With respect to the third party cases or the return of cases, it has complied with all the conditions laid down by the RBI. Now, whether ABC Limited, the Indian company, is required to ensure the closure of entries into the software, the answer is yes. Even post submission of all the documents to the AD bank and post insertion of all the information into the software, Indian companies shall ensure that all the transactions which are actually closed are also closed into the system and there is no pendency into the same. Even here, it shall be noted that when Ashwini sir talk about the ED cases, in certain cases it has been noticed that Indian companies has already closed all the transaction on their part. However, as the transactions are open into the system, they have received notice from the AD bank or the RBI, or even certain cases their investigation has been even started by the ED to know that actually these transaction has been closed, to know the status of the transactions, and the Indian company, as they have received the notice, are under the obligation to reply to these notices and to submit all the required data. So to just avoid these type of situations of receiving notices from the authority, Indian companies shall ensure that all the transactions which are practically closed are also closed into the EDPMS system or the IDPMS system. Now, what are the consequences in case the Indian importer or the exporters are unable to comply with the provision or they violated the provision, and what is its resolution? So the challenges are encountered by the Indian exporter or the Indian importer occasionally, which results to the violation of law, which may further result to notice from the AD bank or from the RBI or from the Enforcement Directorate. And failure to resolve these notices also lead to the comprehensive investigation of the company's business activity. Hence, it is very important to for the Indian entities to follow the utmost sincerity towards these notices, and even before getting these notices, they shall ensure that they are in compliance with the FEMA provisions. Additionally, if any violations are identified during internal due diligence, the Indian party should promptly take steps to rectify the default and shall submit a suo motu compounding application. So, in cases where it is always recommended to the Indian importers as well as the Indian exporters to have a FEMA health checkup or FEMA audit, and they also shall do internal due diligence at a frequency to ensure that all the payments has been received, which shall be received within the period of 9 months against the export of goods, or they have made the payment for import of goods to the foreign parties within the time period. In cases where they are unable to receive the payment or to make the payment within the prescribed time limit, they have taken the extension from the AD bank in cases of third party transaction, or in cases of write off, or in cases of advance payment or advance receipts. They have complied with all the conditions. So this can be checked by the company, and they can also have a FEMA health checkup or FEMA audit to know the status of their transactions. And in case they come up with any default, so they identify any default, they can rectify it immediately. And in cases where the regularization is required, they themselves can go to RBI, submit a suo motu application to compound their contraventions, through which they will they will not be getting and avoiding the notices to be received from the AD bank or RBI or even the ED in future. So thank you all. And this is all with respect to the regulatory framework of FEMA provisions with respect to import of goods and services.
Okay.
Now,
Thank you very much, Sweta. Thanks. Now, because you have given detailed presentation on the legal aspects and some practical tips also, but now come to the turn of the actual person, those who are doing day and night these things. So I will request Mr. Kishore Mamidala to give his practical aspects of how transactions are processed by banks and what you see in all these things and what are the issues. So Kishorji and Anupam Gautam both have to share their practical views. Over to you, Mr. Kishore.
Thanks, Mr. Pawan, and thanks to Ms. Shweta for comprehensively covering the rules and regulations which govern the import-export transactions and also which may impact the importers and exporters transactions. Just taking forward from there and taking to the perspective of an AD bank. So typically the do's and don'ts have been covered by Shweta, and what happens if there are certain things which are beyond the scenarios which have been explained by Shweta, I'll cover from the AD bank's perspective. So EDPMS, as Shweta has already explained, the important part for us is here, AD bank. What does the AD bank do? AD bank is only doing the updation of remittances in the EDPMS portal. So the shipping bill, etc., is covered by customs, but AD bank is only covering the inward remittances which are uploaded into the EDPMS system. So typically, as we talk about remittances, typically an exporter will receive remittances in foreign currency through a wire transfer mode. But there are other modes of transfer which may also happen, and how do AD bank handle such remittances, or how the remittances can come in for an export transaction. So it can come in through a overseas party's bank check or pay order or a postal money order from a post office. It has to come in foreign currency, and a foreign currency note for export realization is a typical no-no. Otherwise, if the exporter can prove that this particular foreign currency cash has come as export proceeds, and if he is in a position to justify the receipt of such foreign currency notes, otherwise all the remittances which are against an export transaction should come through a banking route only. So by debit to FCNR, NRE, SNRR account maintained by a person resident outside in rupees from the credit card servicing bank. So a credit card can be swiped against an export transaction. But again, export should be proved by shipment of goods. The shipping bill has to be generated. The person who is buying the goods from the seller in India and remitting cash through his credit card debit also has to ensure that the shipping bill has to be generated while the goods have been transported outside India. So these are various ways of receiving remittances. And also now it is transactions. Most of the transactions are happening through e-commerce business, and transactions remittances come through online payment gateways. This is another challenge being faced by exporters, where remittances are coming through various online payment gateways like PayPal, Razorpay, Amazon Pay, etc. These are also allowed by RBI up to a limit of USD 10,000. The new policy also, foreign trade policy also allows these transactions, and in fact it puts a lot of focus on e-commerce transactions, because this is how the exports are going to happen in future. So this is another mode of transfer where online payment gateways are allowed to receive, the exporters are allowed to receive remittances through online payment gateway service providers, and these entries are also created in EDPMS system, and the bills are regularized through those remittances. So another important change which has taken place while we always talk about remittances received in foreign currency. Here, RBI has allowed a trade settlement, international trade settlement in Indian rupees, where RBI has given approval to banks to open special rupee Vostro accounts in various banks outside, where they are allowed to open such accounts. So in such case, all imports and exports will happen through invoices in rupees and the currency denomination in rupee. Instead of your foreign currency denomination, the remittances happen in INR only. So as of now, 20 banks in India have opened 92 special rupee Vostro accounts of partner banks in 22 countries. So wherever you require these remittances to be done in INR only, please check with the bank concerned and see if there is an INR SRB, special rupee Vostro account arrangement with those entities with those banks in overseas countries. So another important aspect where exporters find a problem in terms of getting their bills regularized. The shipping bills are available, but remittances are not available. So typically what happens, there are four scenarios where customer receives funds in foreign currency in the same bank where the shipping bills are reflecting. So they have an account in a bank and the remittances are coming there and the shipping bills are reflecting there. Straight case, there is no issue. The bills can be regularized there. There is another scenario where customer receives remittance in a bank where he has an account and does shipments through by using an AD code of another bank where also he has an account. So remittances are received in one bank and the shipments are done with another bank. So in such case, the customer has to get a EFIRC issued from that bank and get the shipping bills regularized. And another scenario where foreign bank transfers the remittance to their corresponding bank, and they convert the remittance and send it to the customer's bank where he holds an account. In such case, the IRM will be created by the bank where the remittance is received in NEFT, but only challenge is the bank converting such remittance has to provide an NOC and credit advice to the bank. And there are cases where Vostro payments, INR arrangement will be there, INR Vostro arrangement, where the remittances come in INR. There also an entry is created by the bank where the INR remittance is received and the bills are regularized. These are various scenarios where remittances can be received. This is on export side. On import side, this is the scenario again. As an AD bank, we only create remittance entries, and prior to 2nd January 2022, all courier shipping bills, courier bills of entry were not part of the IDPMS system. So banks were creating it, but currently RBI strictly said no entry to be created by an AD bank on IDPMS for a bill of entry or a shipping bill. So all entries where courier shipping bills are generated, the courier agents are supposed to upload this data into the system, IDPMS system or EDPMS system as applicable. The entries which are uploaded in the system only will be taken by the AD banks. If the entry is not updated, the correspondent remittances will not be handled by the AD bank. So this is another important aspect. So another aspect where exporters or importers face challenges are imports and exports free of cost. Wherever the customer is doing free of cost imports or free of cost exports, there the entries are present in EDPMS and IDPMS portal, and AD Bank will not knock off those entries unless the corresponding remittance is done. So please ensure the bills of entry or shipping bills are filed under the respective codes only, free of cost codes only, before you file. If you are filing as commercial shipment, these will reflect in IDPMS and EDPMS, and AD banks will not knock off. You will face issues in terms of these bills remaining pending in your IE code, and you will face other regulatory penalties also. Another major change, which again will impact exporters, is EBRC impact positively here. It is not an impact which is negative. EBRC creation, EBRC upload, EBRC generation. So EBRC, what is EBRC? We have discussed. EBRC is electronic bank realization certificate. In AD bank parlance, whenever the remittance is received and against a shipping bill, their bank will knock off that remittance against the shipping bill outstanding for that particular IE code and issues EBRC and uploads it into DGFT portal. So here, what does an EBRC allows does to the exporter? The exporter can use it to avail incentives under foreign trade policy, like advanced authorization scheme, export promotion capital goods scheme, MEIS, SCIS, GMA, etc., and also GST compliances. Wherever the EBRC is not available, the customer will lose on these incentives and also face issues from GST. So current process, EBRC, customer receives remittance, customer makes a shipping bill, makes a shipment, and the shipping bill is under that particular AD code. Remittance is received under that AD code. The AD bank will get the bills knocked off through a request from the customer that these are the remittances against this particular shipping bill. Once the verification is done, that those entries are knocked off, and the bank uploads the EBRC into DGFT system. Customer can go log into the DGFT portal and download the EBRC certificate which is generated. The new process which has started now, DGFT has initiated this process. Banks will upload the remittance entries into DGFT site. Customer can go whenever the shipment is done. The customer can go to the DGFT portal through his login ID, enter into the DGFT portal and generate his own EBRC once the remittance is received and once the shipment is done. Match those entries. Also, the system validates, the DGFT system validates the entries, the invoice number, the value, etc. And once they are validated, the EBRC is self-generated. So here there is no requirement for the exporter to go submit the documents to the bank for generation of EBRC. Again, another important aspect here, the EBRC generation only is migrated to DGFT. The knocking off or regularization of export bills against the remittances received in EDPMS still remains with the bank. So once the EBRC is generated, customer can use it for his various purposes, but the bills knockoff has to be done in EDPMS through a request to the AD bank. So EBRC generation has been decentralized to DGFT. Customer, as soon as the remittances are received against a particular shipment, can go to DGFT portal and get his EBRC generated by himself. Now, currently, various banks are getting onboarded into this particular system. ICICI Bank has been onboarded into this system from 1st February 2024. Various banks have various dates of getting onboarded into this system. So just check with your bank whether they are onboarded into this system and go ahead and take your EBRC online. So these are the facilities which are available on EBRC self-certification portal. IRM, ORM repository, you can go view your remittances available there. Generate EBRC, self-certify and generate. View or cancel EBRC. If the EBRC has been generated wrongly, you also have an option to cancel, but before the utilization. If you have utilized for getting your incentives, you cannot do it. Before utilization, you have to go and cancel. IRM utilization report for what shipping bill has been knocked off, you can go and check. So these are the important references which you make note of. So that's it from our side, from an AD bank perspective. Please ensure the two entries which we have been two legs of transactions on import side and export side, the remittance leg and the shipment leg, though both are available in the system, they don't talk to each other. So it is the responsibility and the obligation of an importer and exporter to go to the bank, get these knocked off. If you are not knocking off, though your your transaction is complete, the entire export cycle or the import cycle is complete, till the time you knock off these entries in the bank system and EDPMS, IDPMS system, your transactions remain open. Both the leg transactions remain open. So please ensure you do this through your AD bank and get yourself free from regulatory compliance penalties. Yeah, thanks. That's it from my side. Anupam, you can take it forward.
Okay, thank you, Mr. Kishore. Anupam, Gautam, can you add some additional point? Mr. Anupam Gautam? Yeah, please.
Yeah, I think the most of the thing has covered by Kishore. And once there will be anything related to an FDI, then I will certainly do that.
Okay. So what I will do
Yeah.
now that the theory and practical part is there, but there are so many queries we have received and we have. So let me just cover this part. So my Ankit, have you joined? Yeah. So I will ask query. These are some questions. So Kishore, Anupam, Ankit, Sweta, anybody can give answer. And if somebody is giving answer and something you want to add, please add. Just indicate to me. Then I will ask you also. So my first is, what if the goods imported have a lesser value than the value mentioned on the invoice? Ankit, can you give answer? Okay, Sweta.
Sir, in cases where the goods has been imported, which have the lesser value than the value mentioned in the invoice, then the very first the importer shall reach out to the foreign supplier to get correction into the invoice and to receive the invoice with the lesser value. Or if the details of the invoice having the lesser value is completely correct, then they have to ask the foreign supplier to to send the remaining goods which has not been supplied. And in the very first case, if the invoice have the lesser value and the goods which are imported into India are the correct goods, then post getting the confirmation and the revised invoice from the foreign supplier, the same information shall be given to the AD bank, and accordingly the details shall be updated in the IDPMS software with the proper remarks.
Okay. So Anupam and Kishore, is there any point you want to add in this?
No, I think that is covered. Only thing is the entry will not be corrected in the system, IDPMS system. The bill will get knocked off with the lesser value and the remaining amount will be shown as written off.
Okay. Okay. Next question. What if exported goods have been shipped to any other person other than the original buyer? Okay.
So in any case,
Sweta, I'm asking the same question. What if the pay mentioned incorrect purpose of the payment?
So in each and every case, whenever the payment is made across the borders, the payee always ensure that they are giving the correct purpose code to the AD bank. And in any case, the incorrect purpose code has been mentioned, then they shall reach to the AD bank to get the corrections with the proper evidences.
Okay. Any additional point?
Typically, AD Bank, while the remittances are initiated, typically AD Bank asks for all the underlying documents. So there is normally no question of incorrect purpose. Only thing is wherever the declaration or the underlying documents have not been shared correctly, in such case, this might arise. But there is an option of getting the purpose code changed through valid documents and a CA certificate.
Okay. Okay. Next question. Ankit, what if the invoice mentioned product A, however, good exported is product B?
I think in that case, we need to rectify the invoice.
So Mr. Kishore, can we rectify these? We have to do something more?
So there might be instances where the customer would have initially planned to import or export certain items, and then basis his requirement at a later date might have changed. This might happen, but this has to be corrected at the AD bank level. This can be corrected basis the assumption that the reason is genuine. If the reason is genuine, AD banks will take a call and do it.
So you mean to say that you have to show the genuine reasonability, then it will be changed.
Yes. Okay. It can happen that customer to do the transaction has done a wrong declaration where the HS code of the goods to be imported or exported are actually restricted. So in such case, it is a suppression of facts. So it should not be done.
Okay. Next.
So that has to be checked by the AD bank.
Okay. The Indian importer has made advance payment to import goods to the foreign supplier. However, post few months is set for an entity bound up. Ankit, what will happen?
Sir, these are, I think, these are cases where there are concerns with respect to the genuinity of the transaction. And there is no such solution that has been prescribed, but then it needs to be looked into why the payment was made to such an entity which just got wound up. And we have in past seen ED taken actions in such cases where there was such just payments and similar incidents happen. So if it is a genuine case where it can be established that the entity wound up through liquidation, some other process which was already ongoing or some things were there, then it would be have to viewed from other perspective. But otherwise, it's a transaction which would be definitely viewed as a serious transaction.
Sweta, just अपना mute करना एक बार. Okay. So now the Indian this is okay. So Mr. Kishore, just go back, Sweta.
Yeah.
This entity is bound up now. So how the Indian importer will do this? Whether this is a because sometimes regulatory bodies are coming on this, they say this is a manipulation. So
Yeah.
how to
So this
say
can be looked at an AML angle as well. So typically, if there is a genuine importer, it can happen because the import transactions are generally transactions between two different geographic locations, and the customer would never have met the overseas party in his life. So in such cases, it might happen, but there are various grievance redressal mechanisms. So first thing is, it cannot happen that as an importer, I do the remittance and immediately the next day it gets wound up. There is a time lag between the remittance done and the foreign entity getting wound up. So what is the follow-up mechanism which he has followed, whether he has reached out to any grievance redressal mechanism like Ministry of Commerce or Ministry of Foreign Affairs, whether he has raised a complaint in the embassy of that overseas country. So basis all those things done, bank will take a call on whether this amount can be written off. It has to be physically written off. So unless it is written off, this entry will still remain. But the writing of process is a little tight in the sense like RBI will not allow the amount to be written off because it is a loss of foreign currency to the country.
Okay. Next question. What is extension of time limit has not been sought?
Time limit on both.
Yeah.
Yeah,
Mr.
yeah.
Kishore,
Sorry,
please.
go ahead. Yeah.
No, I was just mentioning that it has to be sought. There is no other way out because otherwise the entities will not be squared off in the system and there will be other possible consequences arising out of it. But Kishorji, in some cases we have seen where the permissions are not given, then the companies are in a way stuck in that situation कि अब permission तो मिल नहीं रही, AD bank नहीं दे रहा. So is there any way to then escalate to RBI? Or otherwise,
if there are certain guidelines for extension, like you have to have your outstanding realization within those guidelines for the last 3 years. So typically, if a company who has just opened up and then who is asking for an extension, AD bank will never give it. So all those conditions have to be satisfied. In case they are not satisfied, obviously AD bank will not extend these bills.
But then it can be possible to escalate it to RBI?
There also typically RBI will not allow, because if the guidelines, if it does not satisfy those guidelines, then RBI also will not approve. We have seen cases where it doesn't get approved. So in such cases, there is no other go other than following up with the overseas party to get the amount realized or get the goods imported.
Okay, next question. What if the payment is not backed up with the guarantee letter of credit if required?
Up to 5 million, it is already given to AD bank. Beyond that, again, it has to go to RBI. If the case is genuine, this goes to RBI for an approval, and it has to be represented, and it has to be genuinely backed up with a guarantee that it will come. The remittance, which is going beyond 55 million USD, is a large amount. So bank has to do a complete due diligence and has to be 100% sure that the goods will come. In case the payment is going in advance, then only our AD bank represents such cases to RBI, and RBI also approves basis the AD bank recommendation.
Okay. What if the goods imported is not a permissible import?
In that case, it is more to be done with Custom Act, because then it would be a violation that you imported something which was not allowed.
Okay. So what
typically it doesn't get released from the customs code itself. If it is not, the HS code is a restricted or prohibited HS code, it doesn't get released from the customs code.
Okay. Next. In case of Indian importer or exporter has filed any civil case against the foreign party, shall it submit the detail to same to the AD bank?
If the customer is asking for a write-off, these
Then-
things help in writing off.
Okay, if they're not writing off, then
It has to be. This has to be a case for write-off only. Other than that, the AD bank cannot do anything.
okay. Next.
Sir, this generally happens when dues are not being recovered on time.
Yeah.
And in order to also show that all the efforts were taken by the concerned company or the to ensure payment is realized, they have to take such actions.
Okay. Okay. The Indian exporter received payment of export goods to a foreign entity. However, post few months, the said foreign entity bound up. So
Remittance is received, but he is holding the remittance. So here also there is a provision of writing off in case the customer justifies that he will not be able to do anything, and the overseas party is not demanding for such payment to be returned back.
okay. Ankit, have you come across any type of cases?
Sir, mostly it was with respect to imports where payments were made outside.
Okay.
And the goods were not imported ultimately.
Okay. Next. What if the export receipt are not received within stipulated timeline? What is the remedy even if extended time by RBI is left?
Sir, you have to continue to put efforts again and then again try to reach out to present a genuine case. I'm not sure to what extent RBI will give you an extension, but
extension AD banks are permitted. AD banks are permitted to do extension 6 months at a time.
6 months at a time.
A number of times, but it depends on how valid is the case.
And even in these cases, exporters shall make sure that they are submitting the proper evidence with respect to the correspondence made to the foreign client in order to fetch and to recover the amount. So sometimes the exporter comes and say that we had a telephonic communication, or I visited to the place and we had a communication there. They do not have anything into written. That is the email correspondence. So Indian importers shall make sure that they have the email correspondences as well, which evidence that they have made all the possible efforts from their side.
And also typically AD banks ask for a commitment letter from the overseas party that within this particular timeline, they will be able to do the remittance. So basis that commitment letter, AD banks will do the extension.
Okay. Next.
Sir, these are the questions which were
okay. Now I'm
taking
up these questions. So first question: what about the design services?
So we have explained about the design services, that in case someone is receiving the design services from the foreign party, they have to have a CA certificate to evidence that they have received those designs, and accordingly that CA certificate suffices as an evidence to the AD bank and to the RBI as well.
Okay. Can a newly formed entity seek extension for payment of invoice outstanding, since 10% of average import of proceed 2 years will be nil in this case?
It is generally not allowed. Kishore ji can, if there's any other view.
Yeah. It cannot be. I just spoke about this earlier.
Yes,
it cannot be.
Okay. What would be considered the date of shipment for import of service, since time limit for payment of 6 months from the date of shipment, it is invoice date or date of the rendering service?
So generally we take the date of invoice.
Date of invoice.
So the next question is that kindly also explain the consequences of contravention of these regulations. So the consequences of contravention of these regulations, we have already spoke about this into the PPT, in which we have stated that the notices can be received by the Indian importer or the Indian exporter from the AD bank or from the RBI or from the Enforcement Directorate. And the resolution for the same is that Indian importer or the exporter entities shall on continuous basis have the FEMA health checkup or the FEMA audit to ensure that they are complying with all the provisions with respect to the transactions undertaken by them. So accordingly, they will be on the regular basis, they will be able to check their compliances, and within the time, in case of any default, they will be able to take up the default contravention. They will be able to resolve those contraventions, and they can even go to the RBI with a suo motu compounding application, which is a better way to resolve and to regularize the contravention against the way of getting notices from the authorities.
Okay, Kishorji, you have any additional point on this?
No, I think it is sufficiently covered.
Okay, kindly explain the provision for writing back of export receivable which are pending since more than 3 years. Mr. Kishore?
Yeah, what was it? I just missed it.
Kindly explain the provision for writing back of export receivable which are pending since more than 3 years.
So any amount pending for any now a number of years, we look at the eligibility of the client basis the volume, export volume, and export realization done during the last 3 years. So if the customer is eligible and falling into those conditions, write-off can be done.
Okay. The limit of 5% is with respect to the invoice or with respect to year? Can I
With respect,
Huh?
5%
It is with
when
respect
it
to.
is yeah.
Yeah, sir, please continue.
Now, if it is self write-off, 5% of the invoice value. If it is the entire the write-off of more than 5%, then it is year volume.
Okay. Okay. Can exporter write off 5% of a particular invoice every year?
Yes.
Okay. Indian entity exporting service without registration as non-STPI unit, is it legal?
Yes, yes. Without registering, non-STPI units also have a provision to register with STPI. If they are not registered also, it is fine. It is fairly legal.
Okay. There is some big question. A company has imported goods from foreign company which were directly shipped to the third party Indian companies. BOE carries name of the third party instead of actual importer, due to which the transaction is reflecting is IDPMS data of third party, who is not the actual importer. Can BOE be altered? Also, actual importer can't make his payment as nothing reflecting in his IDPMS data. Any solution?
No, this is actually not a way of doing import transaction. If the importer is doing a shipment on his IE code, remittance has to go from that IE code and get knocked off in IDPMS. Similarly, the other way, if the customer is doing an outward remittance in his IE code, the shipment has to come through his IE code only. Cannot come to a third party unless he is doing a high C sale transaction where he is selling off the goods before the goods are reaching the port. So this has to be checked if this is a high EC sale transaction. If it is a high EC sale transaction, AD banks will allow it to be knocked off.
Okay. How do transactions get reported in EDPMS in case of software service exports? Is the exporter liable to inform the AD bank and update EDPMS?
Software service exports only cases where the customer is filing his softex through an STPI. Those cases will reflect in EDPMS. Other services which are not reported to STPI as a software and softex is filed, those cases are not reflecting in EDPMS. So, and it is fairly okay not to report.
Sir, it is always seen in services, in case of import of or export of services, it is fairly difficult even to capture because there is no system.
Yeah.
Like we do work with a lot of foreign clients, there is no such system. Yes, but as and when payments are received, AD Bank do reach out to us to ascertain for what purpose the payment has been. But the manner in which it is regulated in case of goods is quite different how it is regulated in case of services.
Okay. In case of the import, the invoice value is 17,000 US dollar and exporter has given a discount on the invoice is 15%. That is 2,550 US dollar. Also issued a debit note in this respect. In the case, how the bill of entities can be settled with bank? Mr. Kishore.
Yeah, in such case, it has to be discount has to be captured in the bill of entry as well. If the bill of entry is generated for the entire value, customer has to justify through a entry in the invoice, and bank can take a call basis the genuineness and do a knockoff in IDPMS. Otherwise, if it is not reflecting in the bill of entry, if it is not declared in the bill of entry as a discount, then it becomes difficult for the customer. That to that extent, the entry will remain open. The outward remittance is short, and the import is more than the remittance amount.
Okay.
So to that extent, the amount will remain open.
Ankit, whether the old exports received can be received in Bistro account or now?
Sir, I have not looked into from that
So
perspective.
Yeah,
Vostro accounts, and it doesn't matter. Receipts being received in Vostro accounts is basis the relationship of the overseas bank. So if the overseas bank has a Vostro account relationship with the Indian bank, they will do it in Vostro. Only thing is, if the remittances are received beyond the timelines, then the customer would be getting those notices saying that the exports are not still realized.
Okay. Free of cost. Okay. Free of cost export is allowed only by status holder, exporter, or all
It's
exporters.
for everyone. It's for everyone.
Okay.
But only thing is, while filing the bill of entry or shipping bill, they need to enter into the right. They need to file it in the right format, into the right format.
Is it the case that it is mostly allowed where you are sending them as more as a sample?
Yeah, typically exporters do that. They send a sample, and then they file the shipping bill for the entire amount of the shipment. So in such cases, that shipping bill will remain open.
Okay,
so if it is a courier shipping bill, then CSB4, they have to file in CSB4, which is typically for courier sample bill shipping bills. And on import side, it is CB12, courier bill of entry 12.
Okay. If exported without shipping bill, then what will happen?
It does not happen. How it is exported without shipping bill?
It is not possible, sir. If it cannot leave the port or without the bill in place.
Okay. Okay. If the exporter do not supply to AD bank necessary document within 21 days, whether remittance will go back to the foreign importer? What is the practical aspects?
No, remittance and see the 21 days lodgement of the bill with the AD bank for within 21 days from the date of shipment is to ensure that the bank is notified that the shipment is done. So that is different. And remittance, once the remittance comes, it is for the exporter to come to the bank with the relevant purpose code and with the relevant documents. And the typical timelines for a foreign remittance to remain with the bank without being repatriated is 28 days.
Okay. If we want to export material on FOC basis sample, so in this case, up to how much amount sample we can send it in one go?
See, there is no restriction. It is judicious.
FEMA
I cannot
doesn't cover
export
any such
1
amount.
lakh shipment as a sample. So it should be judicious.
Okay, Ankit, what is you say?
I was saying that there is no such amount, but it, as Mr. Kishore mentioned, you cannot send a bulk of goods as a sample.
So this is judicious.
It has to be reasonable by custom authorities. They will see and then approve.
Okay. If AD bank not reported inward remittance after February 24 in DGFT side, who are responsible?
So typically every bank, as I said, has different cutoff dates for reporting inward remittances into DGFT for self-generation of EBRC. So if it is not reported, you will have to approach the AD bank. They will report it again for technical reasons if it is happening. Otherwise, we have put a system in place where it is automatically reported. All the remittances under various purpose codes supplied by DGFT, we are reporting, AD banks are reporting into DGFT side. So it is a system generated reporting.
Okay, very topical subject. Lot of foreign entities got bound up during COVID. Is that a reliable natural calamity accepted to regulator if Indian importer has paid a small advance?
Yes. It will depend from case to case.
Okay, suppose you have paid a high amount, then what will happen?
You have to prove the genuineness of the transaction and the scenarios in which led to these things.
Okay.
Any write-off of foreign exchange will come with a lot of questions. So customer has to be ready with answers. If it is justified, then AD bank will take a call.
Okay. If the export receivable is from a related party and it is outstanding beyond the time limit allowed, what will be the implication?
So exporters are required to comply with the provisions, whether it is from the related party or a non-related party. And if the amount is outstanding, they have to go first with the extension, and they have to submit all the required information to the AD bank that why they are seeking the extension to receive the amount. So there is no such differentiation under FEMA with respect to amount outstanding from the related party or non-related parties.
Okay.
It can be capitalized if required. Such amounts, if it is a related party, can be capitalized. So they can convert it into capital account entry.
Okay. Is non-STPI registration mandatory for service exporter other than software?
No, it is not mandatory.
Okay. What if the exporter receipt are not received within a stipulated timeline? What is the remedy even if extended time by RBI is lapsed?
There is no
Exporter has to make efforts to realize the export proceeds. In case there is genuine reason for him not to realize these export proceeds, he can go for write-off.
Okay. Ankit, if we do not file both APR and FLA return, is there any penalty?
Yes, so these are outlined in the respective regulations. Like APR is under ODI,
ODI
FLA is under
transactions.
FDI. So both are subject to relevant regulations. If you don't file them, you can be subject to necessary penal action.
Okay.
And even the
generally-
regularization is
yeah.
required.
And generally, when you file them late, after some time, you receive compounding instructions or LSF. There are a lot of things that may happen.
Yeah, August 2023, there were guidelines on late payment fees
Submission
and
fees.
compounding, etc.
Okay. In Form FC, Section E, we messed up equity and redeemable preference shares, and it is unearthed during repetition of preference share capital. Could we amend after 5 years?
So though it is a ODI related transaction, not a import export transactions, but yes, on a case to case, it has to be looked into. You have to check with the AD bank to submit a revised form.
Okay. We are in the tea garden and processing business. Could we open to set up a Gujarat gift city?
Not
As per
part
the
of
provisions of
subject, yeah.
IFSC, this is not covered under the import and export regulatory framework. And secondly, to answer this, we have to look under the laws established by the gift authority, and accordingly we can reply for the same.
Okay. If payment received under purpose code P202, any FEMA guidelines?
Freight transaction, no particular guidelines.
Okay. Mr. Kishore, few questions relating to this which is coming. Actually, everybody is traveling from India. So there is one question that how much foreign currency he can take and how much he can, then he's going there abroad and using credit card and debit card. So what is the limit as a layman?
This I'm not into retail remittance, but as I understand, 10,000 USD was the limit in foreign currency cash,
yes,
which can be carried by an individual.
Okay. And if I'm using credit card and debit card?
I think, sir, credit card, I think recently, I'm not sure, I think merged it with the LRS limits. If you're using the credit card and debit card, then subject to LRS limits, you can use them.
Okay. Okay. Acha, and somebody is studying abroad, then will it come under LSR or the LRS?
It would be LRS. If we have to make some remittance, then would be under LRS.
And if somebody is staying abroad, not studying but doing job, then how much he can get?
No, so if he can get as per the permitted transactions of LRS. LRS scheme gives specifies the permitted transaction for which the payment or the money can be remitted outside India. And if the person who is staying outside India is making remittances under the permitted transaction, then they can have it up to the limit of USD 250,000 per financial year.
Okay, okay. So I think thank you very much. We have covered all the queries which we received today and through email, and some query which has come out in the questions. So everyone has given answers. So my thanks to Mr. Kishore, Mr. Gautam, Ankit and Shweta. Everybody has nicely covered this topic, which is actually, it's a complicated subject when foreign trade issue connect, and very lucidly Shweta has given explanation. And so my thanks to all of you and my thanks to participant. If your any question is not answered or you think there's some questions, you please write to us. We will try to give you answer. So as a customary, we have a just concluding remark from everybody's side. So I will start with Kishore from your side. What you say about this law and this subject, and what advice you want to give to users?
Yeah, as I said in my parting remarks while I gave the presentation, typically again exporters and importers do not know the regulatory complications of not adhering to the framework or not adhering to the FEMA guidelines, etc. While they do the transactions, they do not know that they need to go to the AD bank to regularize those transactions. So while both the legs are completed, the customer is exporter or importer is happy that he has done the transaction completely. This does not get knocked off unless he goes and informs the AD bank that these two entries are done. So please, any importer exporter who is part of this conversation, please go to the AD bank, find out how many entries are open on your I code, get those knocked off if both the legs are completed. If they are not completed, please do whatever is needed, either an extension or a write-off or invoice reduction or discount, whichever is given to be adjusted, or push the overseas party to do the realization or send the goods on priority. So unless you inform the AD bank will keep following up with you, RBI will keep following up with you on both the entries which are related but open in your IDPMS or EDPMS system.
Okay. Anupam Gautam ji.
I think he is not there, sir.
Okay. Sweta.
So compliance with the FEMA provisions is very important, and there is no getaway from the contraventions. It's always better than the Indian parties ensure that they are complying with the provisions. And in case they are not aware about the provisions, it's better to have a professional on board to help them to comply with all the FEMA provisions, either it's import, export, FDI, ODI, or ECB. There is no getaway. They have to comply with. In case of any default, it's better to identify those defaults by way of internal due diligence or audit, and do the regularization suo moto. Do not wait for the notices from the authorities. If you get it, you are into a trouble, and you have to reply accordingly with all the correct facts. So it's always better to be very diligent while doing any cross-border transactions.
Okay. Ankit, how you are helping your client and advising to them?
I think, sir, first of all, in case of FEMA, AD bank is the best friend. We should always keep that in mind. Because they are doing it day in and out. Practically, a lot of things, everything is not written in regulations, master circular, or directions. A lot of things also they are communicated internally, so they are in the best position to help you out. What we have seen, I think most of the common thing that Kishorji also mentioned is in the IDPMS, CDPMS entries, where we are working with a lot of good companies, big companies, where there are hundreds and 200s entries pending in both these systems, and we are helping them to knock them out with the AD bank. So I think monitoring, regular diligence, awareness, because, sir, if you see, this is something not which is restricted to companies, partnerships, proprietorships. Everybody is into this business, big, small. So for them, what is important is payment and goods. To that extent, they make sure things happen, but to the extent the regulatory compliance are there, at times they find themselves in a sticky wicket, though they have acted genuinely and with reasonable assurance. So, as Shweta also mentioned, be in touch with AD Bank, have requisite professionals on board who can help you in navigating the landscape concerning these provisions.
Okay, thank you, Ankit. Thank you, Mr. Anupam. Thank you, Kishore. You have covered every question on a practical aspects. We have done some poll. Just I'm reading the answer of the poll. How familiar are you with the foreign exchange management of 99? 55% say somewhat. Very familiar is only 30%. So you can understand this particular thing has required more familiarization and more understanding. So this is one point. In your opinion, what is the biggest challenge faced by Indian companies under FEMA regulation? Understanding, implementing procedure, 42. making foreign exchange risk 42 or 24, hedging the risk, complies with document requirement 23, and dealing with the penalties for non-compliance 11. So understanding and implementing process is 42. So Ankit and Sweta, you have good opportunity to tell your clients what they should do, and you can help them. So I think these are two very important points which everybody has given answer to this. So with this thing, thank you very much. Thank you all once again, Kishorji, Anupam, Sweta, Ankit, for doing this. So thank you very much. Friends, this sharing of knowledge will continue. And as I informed you in the beginning, our next webinar, or 171 webinar, is on buyback, a strategic decision which will be held on 10th May 2024. So this is one very important topical thing. So many companies are coming out with buyback. Why people do buyback? What are the issues? And how the buyback procedure is there? What are the modes of buyback? Whether it's a simple one type or two type or three type. Each and every point will cover tax aspects, the stock exchange aspects, SEBI aspects, and all legal aspects will cover, and how and why companies are doing, the reason, and how this will be useful for the investor, promoter, and company as a whole. We will discuss all these points on 10th